Alrighty, guys, welcome to day 6 of our foundation. Sorry I was away for the weekend. Had Mother's Day, spent some time with the family. But we're back. We're back. We're picking up at probably the hottest episode you will see in the foundations, the most important episode you'll see. That's exactly why I'm splitting it into two separate parts. So today we're going to be talking about liquidity, the big word, the massive word, the whole reason that I trade, the whole thing that directs any sort of one of my trades is liquidity. And we're going to get into every small definition of it in the markets, kind of show you where to find it, which is it's literally everywhere. You'll see it literally everywhere, specifically in indexes. But like you could use this for any market you want, like whether that be crypto, options, forex. Forex is also very similar to futures as far as confluences go. But you could see it in literally every single market that you could possibly trade. Looking at candlesticks, regardless, if you push candlesticks aside, any sort of thing that makes the market move, it is literally always liquidity. So we are going to get into it. I hope you have your pen and paper out because there's a few notes we're going to be talking about. A few things to write down. I kind of have on the side here. I'm just going to type it up for you guys on the screen. But yeah, so let's get into the charts here. Actually, I may take this off first because I had the level marked out earlier. I don't want you guys getting spoiled here. No spoilers. So we're going to go up here to a blank. Here we go. Okay, awesome. So now we have a blank drawing board that we can just write on here and talk to you guys about. So let me get into the maybe 1 hour, just so we have more space. Okay, so first off, the basic definition of liquidity, if you want to get as basic as possible. I hope I spelled that right. Yeah, okay. As basic as possible, disregarding the market, disregarding everything else. If you're just talking about strictly liquidity, it is how fast you can turn something into cash. And that's kind of where the term liquid cash comes from. So whether that be gold bars, houses, cars, literally anything within your possession, any asset that you have, to determine how liquid it is, you kind of just go based on how fast you can turn that into cash. So for gold bars, very liquid item. You could just instantly cash it in plenty of like a plethora of stores around you. Um, as far as a house goes, not as liquid. It's probably one of the least liquid things. Maybe not the least liquid. Well, it's up there. It might take a long time to put on the market first, or get appraised, and then put on the market, and then sold, and then everything just has to clear and check through. So in order to turn a house into liquid cash, it takes a lot longer than to have a, a bunch of gold bars, um, or a house worth of gold bars to turn into liquid cash. You get that cash a lot quicker if you just have those gold bars. So back to that definition, liquidity, how fast you could turn something into cash, literally anything, any sort of asset that you possibly have. So the three main components, I don't know if I should write everything down, but you know what we'll do? Three main components of liquidity. So number one, we have a tight bid to ask spread, not bid, spread. And so this is like this three main components that we're talking about here, what makes something liquid. This is referring to the market, right? So the first definition we put out there is strictly about just anything in general, but you could kind of apply that to the idea of the market. So if you want to directly apply it right now, how fast turns something into cash? What are we talking about? Something orders, open orders in the market. So how fast can you go from having 20 contracts within NASDAQ to now being fully liquidated and out of your position, whether that be for a loss, for a win, or for a break even, right? And we'll go into actually what break even really means in the market when we go into slippage here real soon. So tight bid ask, and what that really means is what someone is willing to, or what price someone is willing to buy at, and the lowest price someone is willing to accept to sell. The highest price. So all this really means, you could think about this like before we had all these computers, before we had all these computers and this technology, and firms doing it for us, like Robinhood being one of them, just doing these transactions back and forth for us. You had the trading floor in New York, right? So you go to the trading floor in New York, and it'd basically be just a massive auction house of people just selling um, tickets to each other, basically of a value of a stock. or just a certain quantity of stocks, and they'll just sell it at a certain price. They'll sell the other price, someone will accept it, and boom, you swap it. Right now, that's a little bit inconvenient, especially now that we have computers. So here we have a faster way of expediting this process. And now it's not back and forth between a small group of people on a trading floor. It's now between millions of people on the market. So that doesn't excuse the fact that it's still the same, right? It's still the same as a personal reaction or interaction with you and somebody else, whether you're the buyer, they're the seller, or vice versa, right? So I always say this as like kind of a realization moment for people, because people that just think they're clicking the buy button and they're betting the market goes up and the money just comes to them magically. But realistically, what you're doing is, if you're in a winning trade, someone else is losing money on it. And if you're in a losing trade, someone's making money on you, right? It's just adverse effect, right? Up and down. The money cannot be generated from nowhere, right? You can't just spawn money out of nowhere and it comes into your pocket, right? So if you're losing money, chances are there's somebody out there, or a big group of people out there, or one massive firm out there that part of their winnings is all of your losses, right? Or vice versa. Let's say you now running a $1 billion company and you're moving money within the billions or the trillions within the market, then all of your winnings is made up by all these other people, whether that be firms, retail traders. All of your winnings or losses are made up with all these other people that are liquidating you. So yeah, the tight bid ask spread is basically just how close this price is from one person willing to sell it to another and one person buying it from that person, right? So like the tighter it is, the closer this number is, the better, the more liquid the market is, because there's not a gap between prices, right? So and then again, we're going to get into that later with fair value gaps and what a gap between prices looks like. But that actually has more to do with more liquidity in the market rather than less. But again, tight bid ask spread um, introduces more liquidity into the market because there's more levels at which people can buy and sell stocks, right? Or indexes within futures, options, literally what, again, we're still talking about whatever market you want to talk about. We're not mentioning futures at this point yet. But yeah, so that just means there's more people available at different price levels. So I mean, like while we're here right now, just showing you all these price levels over here, if price were to come up here, there would be every single one of these levels would have a million lines marked out on it, just a bunch of lines of people that are willing to buy or sell at these levels, right? So that is what that tight bid ask spread is. Bid ask spread, tight bid ask spread. It almost sounds like I'm saying ask spread. Anyway, that's what that level is just blank amount of people that are willing to buy or sell at these prices is what makes the market move so much or react so much at certain levels, right? Okay, on to the next point here. Am I this right now? Okay. So the second point we're talking about is market depth. Uh, the volume of buy and sell orders at various price levels. Volume of buy and sell orders at different price levels. This is kind of getting redundant because, again, liquidity isn't a hard thing to grasp, but you see it everywhere. This is almost the same thing as tight bid ask spread, where it's just now instead of, I spelled market wrong. Now instead of because I kind of already like tapped into this idea a little bit, but tight bid ask spread is specifically about one person's price against another person's. Market depth is now introducing a lot more people that are willing to buy and sell at that price. And also thousands of other prices that are marked on the side here, right? I don't know if I mentioned this earlier. I think I said this in another video with how to the first foundation, how to work trading view with the ticks here. Again, one tick in NQ is 25 cents, right? So you cannot go, let's say the level we're looking at right now, we have marked that as $21,439.50. You can't sell or buy between that price and let's say 21,439 and 25 cents. So you can't just assume, or you can't just say, yeah, I want to buy at the 30-cent level, right? That's not possible, right? The orders only fill at these tick parts, right? These tick markers, no less, no more, no in between, right? Or not no less, no more, but no in between, right? So that is the smallest, I guess I don't even know how to put this, right? This not really indication, whatever. It's the smallest amount of money that you could possibly put within that dollar amount, right? Is just by the quarter, by the quarter dollar. Well, I'm like tripping over my words here. Anyway, I need some water for these videos. They take a while to make. 9 minutes already. Shit. Anyway, so number three. Also, yeah, I guess the one more thing you want to add on to here. This just means deeper order books equals more liquidity. Like we said before, the more people that are willing to buy or sell at a certain level, the more the market will move accordingly to that point, right? Now the final point here, a final component of liquidity, would be our execution speed. And this is a big thing in a lot of other markets, not exactly futures, or again to a specific reason why, but you'll also see it within futures markets how fast you get executed, depending on how liquid the market is. Excuse me. So this is how quickly your orders, or anyone's orders in general, can be filled. So in a very I can't type. I keep factoring these keyboards. You're gonna see me probably make some mistakes here. Just assume that it's the right word and not the wrong one if I miss my mistake. But in a liquid market, executions are quick and efficient. All right. So yeah, the three main components here of liquidity: tight bid ask spread. I don't like the way I put that. It sounds really easy to mess up. Anyway, tight bid ask spread. Basically how much I'm gonna be redundant here. I'm gonna keep saying this over and over again. Just to reiterate what I was saying before, the highest price someone is willing to buy at compared to the lowest price someone is willing to accept the sell. Market depth, the amount of people that are now at that price level doing the bid and asking, and then the execution speed, how fast these orders are being filled through a plethora of platforms or the singular platform that we're looking at currently. So now we're going to go into why this is important. So importance question. I really hope you guys can see that. I think you guys can see this. Yeah. Yeah. Importance. So when we have liquid markets, so there's a lot of liquidity flowing within the market, it's a more predictable price action. I wasn't really good at English, you can tell. And this provides clear structure within the market. So this is going to end why we actually want to trade more volatile or more liquidable times, and why I personally like trading New York session, which is why, I mean, the main reason, because it's more liquidable, more volatile. Personally, why I like trading New York session, and why most people prefer to trade more liquidable and more volatile sessions, and kind of also leads into why you should stay away from the market, especially the futures market, during any other time, right? There's certain kill zones that we say, ICT kill zones. And those are the areas or times within the day that you'll see the most volatility. And then in between those kill zones, it'll just be basically dead. The market won't really be moving. It'll fluctuate 20 points. It'll be like a 20-point range, kind of just play an accordion. And then eventually you'll break back into a kill zone and have more of a breakout, more of a movement. So those little moments where we have that kind of accordion, I guess we're going to talk about this too. I was going to just, I guess, give you another definition here. When you have big movements in the market, right? Like I said, kill zones. And then you'll have areas where you have just this, right? Just kind of not moving much. And what we call that is consolidation, right? I'm going to write this down here. This, no matter how much structure I try to give my videos, it always ends up being just me moving on to something else, talking about something else. But this, I think I have this here. No. Okay. Anyway, we'll mark this out with a black box, put a text box next to it, and just say consolidation, right? So when the market is consolidating, kind of just compacting itself, you could think about it. Prices don't really want to break out anywhere. We're kind of stuck in this specific zone, and we're waiting for something to make us move, whether that be more volatility in the market, like if there's a New York open, London session open, Asia session open, that's literally just more people trading at once. That's kind of what volatility and liquidity comes down to for the most part, is how many people are now sitting at their desk executing orders, and that's going to make it move. So again, back to the three main components of liquidity. When we talk about market depth, that literally just means how many people are now looking at their screens and setting orders on them. And that's what makes the market move. Because if, let's say, you have any sort of time of day, even if it's New York open, but people aren't trading, right? There's days where this happens, right? There's days where people are kind of sitting back at their desk and waiting for something to happen. Let's say there's a big news event coming out. Let's say, during the election, it was kind of different. Like it was like fluctuating a lot. And then they would have consolidation phases because people were waiting for some big news to come out so they could leverage and trade on that. But again, like you don't see this a lot on big market session opens or on big kill zones, because a lot of people are just straight out putting executions out. But for the most part, right, more people out there at their desk placing orders the more market depth, which means the more volatility you'll have, which means the more liquidity in the market, which means the more opportunities you have to take your trades, which again goes right back full circle to why we trade on New York session open. Now, obviously, for people that don't live in New York or the East Coast or even in America, completely different for you. And it's completely okay to trade Asia session, London session. And that also goes for people that do live in New York or within the East Coast or again, anywhere in America, right? It's complete preference. It's completely up to you. For me personally, I trade New York session because one, I live right next to New York. And two, it is the most volatile session you will find throughout the day. Anyway, that was my rant there. Going back to typing over here. So more predictable price action provides clear structure within the market. And that just gives reliability to market behavior. So, and the second thing we're going to talk about here is tighter spread or lower slippage. So when I was mentioning before that futures markets and crypto and everything else is kind of different, but fundamentally similar, that's when we talk about liquidity. But the kind of difference in liquidity would be like slippage. So I'm going to explain this in a second. This is reduced cost per trade. Now we say, what do you mean? Right? Are you paying for your trades? Technically, yes. And the whole idea of this is when you're executing a trade and there's not a lot of liquidity in the market, let's just give another diagram. I'm going to delete this diagram. I hope you guys drew this already. If not, you pause the video and get that down there because it's kind of not really what we're talking about as far as liquidity goes. If we're in a market and we have price moving, but let's just say price is moving, but there's not a lot of people buying and selling at this time. So a great example I give you is crypto markets, especially meme coins. They will open up and have great volatility, but also not a lot of buyers and sellers, especially towards the end of its lifetime. So you'll have this great big movement up where just price is absolutely rallying. And when people are trying to execute their orders, especially when the market starts crashing or even when it starts returning up here, right? And crypto specifically and meme coins specifically, once you reach this kind of peak and you start crashing, chances are you won't have a revival, right? Every meme coin has its own deathbed. So when people see this, the peak of doom, they start to insta sell, especially when you get this pullback, right? But this pullback, all it is just to collect more liquidity up here to now liquidate people. So what are you going to see now? People selling, the whole market selling. But like I said before, you have to have a buyer if you're going to be a seller, right? There has to be one. Now, in a market where there's only 1,000 people executing these trades and now everyone is spamming sell, you can now no longer have a person that will buy your shares, that'll buy your minted coins, that'll buy whatever quantity of whatever you have here. So this goes specifically for markets that are low on liquidity or don't have a lot of executions or orders going through. But again, for all intents and purposes, you can imagine the crypto market is the best example here. If people are spam selling now, and even a good representation of this is down here, this lower bar that goes right above my head. This kind of tells you in the days range how many like if we're down in the days range, up in the days range. I can actually go to deck screener here and show you something else. And this is kind of going to give you a good visualization of what you're looking at. This is meme coin markets. I don't discuss meme coins. I don't talk about this shit at all, but it is a good way to gauge liquidity and kind of, oh, I just moved my screen somehow. What do I do? All right. Gauge liquidity and kind of get your mind on what you're looking at and what the executions of orders are. So we have Moonut, whatever that is, and we're going to just look at this over here, right? So within the last 5 minutes, this is kind of a bad example. Not relatively, actually. Yeah. So we can say in the last 5 minutes, in the last hour up here, the market is down 16%. The last hour is down 37%. That also shows itself on these charts. So what does that mean? A lot more sells than there's buys coming in. Now within the last recent 15 minutes, it's up now. Actually, this whole market is kind of pumping, so it's kind of hard to show you the exact example I was trying to give you. I was trying to find a dying coin, one that has recently been put to bed. Wow, these are all actually just getting their second wind. Can we find something? Italian brain rot. Yeah, why are all these kind of alive? I guess it's because we're on the main screen of deck screener. We could do trending in the 24 hours. And then just scroll down. We should find something here. Sorry, guys. Oh, see here, this is kind of already what I was talking about, right? So market dips down, like the exact diagram I was painting out for you guys here. Market dips down. Actually, exactly what I was going to paint out was this movement here. It's just going to go down, right? So market comes up, hits its peak of doom. And this is actually a liquidity sweep you're seeing here, which we're going to get into in the next video. But it hits this peak here, liquidates, comes up, and now this is the level where you're going to see everybody start selling because now they're saying, all right, the coin's not going to come back alive again. We're not going to see it come back. This was its peak. Let's all sell. Let's all liquidate our positions. Now, obviously, because this coin is so low now, we got a lot more buy orders coming on the bottom here. Where people are like, getting a second one and saying maybe this could come up, and now they're buying at a discount price. Which, oh, that's also something I have to talk about. But yeah, so anyway, like we were saying, at a certain point, I mean, even now the buyers on the market. But this again, this is what shows you how many buyers there are and how many sellers there are within this respective market. You can see here the numerical amount of buyers and sellers doesn't matter, especially in the crypto market, because people have a lot of dirty ways of doing this stuff. So they'll actually hire bots to spam buy 1 cent worth of whatever meme coin this is. This is also useless information for you guys that want to get to future trading. But at this point, I'm just talking, so I'm going to keep talking. People will make bots that purchase the coin for 1 cent so that when people click into this 5-minute view, it says, oh my God, there's 135 buyers and 42 sellers. But look over here, buy volume and sell volume, even if there is a significantly less amount of physical sellers versus buyers, we are having a sell volume of $20,000 and a buy volume of 14,000. What does that mean? You are going to see a dip in the market because there's more sellers than buyers. That is just a seller bias market. That is going to be a bearish price action market. That is going to be a lot more bearish orders coming in. And you'll see a market that looks exactly like this, a big fall off, a big goodbye. So anyway, what I was going with this. Right. In lower liquidity markets, people won't get filled at a certain point, right? So for people that are now trying to sell and they're panic selling here, you can imagine they see this price, let's say hit this level, like, I gotta get the fuck out of here, right? They try to sell. This is actually a bad example. I'm gonna try a better one. Okay, on this down candle here. Yeah. Okay, ready? So this is kind of a sign of like what you would see. This is on a 5-minute time frame. You can even look at a 1-minute time frame. You just see this one like absolute panic candle print here. So let's say price is consolidating, like we were talking about before, using big words, using new words you guys know now, right? We're at some sort of range here. We're consolidating. And someone looks at this and says, I want to get the fuck out right now, right? I don't really enjoy this anymore. There's no reason that this is going to pump anymore. This is already a dead coin. So they try to execute and leave, right? So maybe the first 5 people are going to get it. Someone's going to buy their position. Maybe the next 5 people might get it. But now that the market's crashing, and everyone is selling, no one is buying anymore, right? So these last, let's say, 10 people that now want to sell, even though they click the sell button at this level, because the market is falling so hard and no one is buying their orders, you are now going to execute your trades, or your trades are going to get filled down here. Now, that is the literal definition of slippage, right? That is what slippage means in its whole form, right? So when it talks about slippage in the market, this is an extreme sense. I mean, this is literally like a massive movement that you'll miss. As far as futures goes, is going to be more like, really tight, especially if you're like reaching a certain levels of liquidity, it'll be very tight. But in crypto markets, because there's not a lot of order flows coming through, you'll have these levels where you'll fill at one point, or you'll execute at one point, and you'll fill much later. Whether that's you're in the green now because of it, or you're in the red now because of it. Because there's also areas where it's vice versa, right? It's not always about selling. And let's say people are buying the market up now, right? So, and this also flips around for you buying it and selling it when it's at its peak. So let's say you're buying the market up right here, right? But now no one's selling. No one's selling because everyone wants to buy it. Everyone's seeing this run. So instead, your order gets filled up here, right? That's fine though. We got more room to run. We're running, right? And then you come up to this level here, like, all right, I 2x my money. I want to get out now. I want to get out now. I'm done now. No one's trying to sell their positions anymore, right? Everyone's still trying to buy back. So actually no, this is completely false. What am I talking about? Yeah, sorry. So if the market's running, and it's going upwards, right, and you want to now sell your positions, your order is going to get filled very quickly because there's still a lot of buy orders coming in here. This would only work, and what I was trying to talk about before is if we're at our peak, right? So now if we reach our top up here, right, again, like we said, you try to buy here, or actually gets filled here. People sell what you're buying. Comes up here. Now it starts to drop, right? You're like, oh, I want to sell. This is the same thing I was talking about before, right? It's dropping, but now nobody wants to buy, nobody wants to buy what you're selling, right? Now that you have stake in this crypto market, in this meme coin, nobody wants to buy now what you're willing to sell to try to cut your losses now that the market is dying. This is a long-winded way of me trying to explain liquidity, and I hope I explained it in the best way possible, because this video has now been running for 25 minutes. But yeah, that's the kind of the basic way for me to explain slippage to you guys. And in futures market, it's a lot different because we have a lot more volatility and a lot more liquidity. So you won't see these kind of points where you have this sort of like slippage fine, if you want to call it. But that is what we consider the cost per trade, right? Is the slippage. So when you get filled, you could have made more, like all things considered, in a perfect market where it was perfectly liquid and everything gets filled instantly, you could have made more, you could have made less, right? Just depends on market reacts on it. But regardless, there's going to be a cost for that trade because you entered it and you have that sort of slippage, right? So for me, when I enter and take a trade break even, you see it posted on my Instagram, and I think I made a video about it last week of me going break even on the trade. Even though I went break even on my overview for my funded futures, it says I lost $70, right? What's $70 in a trade that could have made me $4 grand or lost me grand, right? That doesn't really mean much. So that is really just the cost per trade, and that was on three different accounts. So it would have been like, $22, $23 at the most. So it's not that big of a deal, right? It's not a lot of money, but that would be the cost per trade in markets that are very volatile, right? It won't be a lot, but it'll be something. Now, for something that's like this, right, where it's crypto, you're going to see a lot worse slippage. You're going to have a lot more problems with filling these orders and getting executed on these orders. Wow, like crazy tangent we just ran on. This is supposed to be a short video, but anyway, so that's the importance of it. Now we're going to go into what do we have next? Liquidity in futures now, right? So push everything else aside. Now you kind of get the idea of what liquidity is, or I really hope so. I'm doing my best to try to explain it here. So if anyone has any questions, again, put it in the comments, DM me on Instagram. Tell me what you think. Tell me what you know. Tell me what I'm missing in this video. For anyone that actually knows what liquidity is, tell me what I did wrong. I hope I didn't do anything wrong, but tell me what I missed in this video. But all right, so now we're moving to liquidity in futures, and what we know about it. So we trade on a centralized exchange, which you could see in the top right here. We trade micro E-minis, NASDAQ 100 index futures on CME. And what that means, CME is Chicago Mercantile Exchange. They're really helping. What is a G there? Mercantile Exchange. Yep. Chicago Mercantile Exchange. And this is what pools all orders into one place, right? This is exactly what gives the market so much volatility, is instead of us having 13 different exchanges, you'll have this one exchange that everyone knows about, that everyone trusts, that everyone uses. So now every single order that's being filled, everyone that's trading is trading on one like simultaneous platform. I mean, not everyone, obviously. There's other people executing on different platforms, but for the most part, the CME is the most included platform and one that everyone trades on. Again, not everyone, most people trades on, and that is what pulls all the orders together and what gives us the liquidity and volume. So if you can imagine a world where everyone had their own exchange, this is crazy talk. That doesn't mean anything. But if everyone had their own exchange, nothing would happen because there's no one to buy from your exchange, right? So if I'm on my own TP3 on Eric's exchange and I'm gonna hop in the market and I wanna, I don't know, buy in, right? Who am I gonna buy from? Myself? That makes no fucking sense, right? So you need to have um, a massive group of people, or like one determined area where people could all come and make purchases or make sales on these stocks, on these indexes, on these futures, on anything, any commodity, where people know where to come and buy and sell. So there's so much more liquidity and so much more movement in said market. So yeah, that's basically it. Moving on to the next thing that I have written for you here is standardized contracts. Wow. Standardized contract. That's embarrassing. Sorry, guys. 1NQ mini is equal to 20 NASDAQ index. So again, contracts, like anything else, is just a bundle of something. So right here, since you're not actually allowed to trade an index on its own, so you have to bundle it together into some sort of contract, which is what CME is offering us, which is known as, the NASDAQ micros or E-minis. So for me, I trade micros because I leverage 50K funded accounts. So that being said, if someone has a lot more equity to their name, it might be better for them to leverage minis instead of micros. But the only difference is a micro is a tenth of what a mini is. So instead of it being like this, I'm even gonna write it down so you guys just could have this written in your books or have it in your mind. NQ micro is actually only 2 times NASDAQ index, right? So it's a lot more easier for me to kind of gauge how much I should enter a certain position as opposed to only having that one option of one NQ mini, right? So for me, I kind of usually enter between the number of 15 to 25 micros. And this is completely depending on what, like where I'm at within my journey of funding account. So if I'm trying to half port, it's going to be 25 micros, but you can't do halvesies, right? You can't just do 2.5 minis. It's you have to buy a whole contract, right? So that wouldn't make any sense. Or 1.5 minis. 1.5 minis would be 30. Regardless, you get the idea, right? So I can't cut this shit in half. So the best I could do is now take one NQ micro and then kind of multiply it. So get 10 of those. Now 10 of those again is going to be one mini. Then if we do 15, that's now 30, right? So now that's now 30 NASDAQ indexes that I'm buying instead of, trying to do 1.5 minis. It's not possible, right? So that's what micros helps us to do, is kind of limit your size or gauge specifically how much you're willing to risk rather than lose, right? So if you're in a massive pool, you have billions that you're trading, micros makes no sense because you're going to be going in for, 1,500 micros, right? So why not just go for 150 minis, right? That doesn't make any sense to trade micros. Also, micros has a lot more issues with liquidity because of that, because a lot more whales trade in the mini sense. I mean, I think they're all still pooled together within CME, so it doesn't change much of it. It doesn't make much of a difference. But I've seen times where candles print differently in small senses, like all things considered, Nasdaq should be Nasdaq and it shouldn't change, especially within futures. But I've seen it like instances where it looked a little bit different. One time where it actually threw me off and didn't allow me to take a trade, which I think I went over that in one of my trading recaps. You guys could watch that. I think it was like one of my first videos too, like second or third video that I made. Anyway, yeah. So if you could trade minis, I recommend trading minis. If you have to trade micros because you're trading a 50K or 25K account, trade micros. Either way, you're gonna find your trades. You're gonna take the trades. You'll be fine, right? Like anyone else's, you'll be all right. Just don't risk taking minis if you don't have to, or you shouldn't, right? Like there's a very thin line between, take micros, limit your position sizes, don't bust your account, and take minis because you are able to, because you have that sort of equity in your hand, right? So I'd say do your research on that. But for me, I'd say if you have 50K or 100K account, or you're trading with 50K to $100,000, or if you want to set several TPs, then trade micros, right? I don't set several TPs. As funny as my name is, being TP3, that used to be my old model. Now I just do a singular TP. I don't set several TPs, but regardless, I like to be able to gauge my position size and gauge how much I'm risking in my trade, which is why I trade micros for my 50Ks. For everyone else that's trading over 100K accounts, you'll be fine with minis. You'll be just okay trading minis. Again, calculate your risk when you're taking your trades, whether that be mentally like a rough scale of it, or literally mark it out on your charts and calculate it and find it out based on your tick sizes or your pip sizes. So anyway, and I think I'll probably make a video of that in the future as well. But that's liquidity in futures. Um, yeah, another thing to note is a combination of these two is what leads to a standardized market. So now that everyone's on the same exchange and everyone agrees to what the size of contract is, we can now trade the same time, the same things, and move the market doing the same things together, right? So instead of having to go to a middleman for this, everyone knows that one NQ mini means 20 NASDAQ indexes. One micro means two NASDAQ indexes. And then we're all trading on Chicago Mercantile Exchange, so we don't have to hop between exchanges, send it between banks, do any of this bullshit, right? It's just cut clear and dry back and forth stuff, and that's what creates liquidity. There's no in between, there's no downtime. It's just straight back and forth, and that's what we see in a lot of these futures markets, is a lot of volatility, a lot of movement. Wow, I think this video ran long enough. Um, at this point, we haven't discussed yet what liquidity looks like in our trades, but all these things are very important to know, to define, to keep in your head, specifically for people that actually want to go beyond trading futures. Because I could just show you a roadmap of how I trade and give you my model, and you could easily learn and figure that stuff out, which again, we're going to talk about that very soon in the next few videos. But this kind of helps you gauge other markets too, and have an overall idea of how this shit works in general, right? Not just futures markets, but any market you ever want to look at, right? This is going to help you a lot with these things, these definitions, these ways that I've tried to explain it to you. So again, I hope I explained it well. This is just part one of this, so stay tuned for part two. I'm probably going to post it tomorrow. I'm excited for that, actually. As you guys can tell, I love talking about this stuff. But yeah, so I'm excited to see you guys later. Thanks for coming, and I'll see y'all soon. Good night, and God bless.